IFRS 16 leases, initial measurement of the lease liability in the books of the lessee. The following variables will be used for purposes of determining the present value of the lease payments. The initial measurement of the lease liability is at the present value of the lease payments. We have already looked at determining the payments variable. We've looked at determining the future value variable as well as the lease term variable. So this presentation will now focus on determining the interest rate that should be used to discount all the payments back to the present value of those payments. In terms of IFRS 16, these payments should be discounted back using the interest rate implicit in the lease, if it is readily determinable. If you cannot determine the interest rate implicit in the lease, the lessee's incremental borrowing rate should be used. This is an extract from Appendix A to IFRS 16, indicating the definition of interest rate implicit in the lease. It is the rate of interest that causes the present value of the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct costs of the lessor. So the variables we have to input into the financial calculator would be the following. We need I. So we need to use this definition to guide us towards the variables that's necessary to determine this interest rate. It is the interest rate that causes the present value of the lease payments. So we definitely have to input all the lease payments, including the amount payable under a residual value guarantee. The unguaranteed residual value, which will form part of the future value of the lessor, that would equal the sum of what? The fair value of the underlying asset and any initial direct costs incurred by the lessor. The interest rate that would cause these payments and future values to discount back to the fair value of the underlying asset and the initial direct cost, which would then be your PV, would be the interest rate implicit in the lease. What's important to note is that this definition is from the perspective of the lessor. The reason I'm saying that is because you also have to consider the unguaranteed residual value as well as the initial direct costs of the lessor. That is variables not influencing the lessee at all. So the interest rate implicit in the lease is determined from the perspective of the lessor. With that background knowledge, we will now look at class example 8, which illustrates how to determine the applicable discount rate. Poly Limited entered into a 5-year non-cancelable lease agreement with Kiki Limited to lease a piece of equipment. The contract is a lease per IFRS 16. The following information has been extracted from the lease contract. The commencement date is 1 January X15. The annual lease payments payable annually in arrears on 31 December is 100,000. Poly Limited incurred initial direct costs of 1,500 relating to the lease. Poly is the lessee. Kiki incurred initial direct cost of 5,000 Rand related to the lease. Kiki is the lessor. The lease contract further specifies a residual value guarantee of 40,000. If the fair value of the piece of equipment at the end of the lease term is less than 40, Poly Limited will pay as part of a final payment an amount equal to the difference between the fair value of the piece of equipment and 40,000 Rand. That is for purposes of determining the future value payable by the lessee. On commencement date, Poly Limited estimated that the fair value of the piece of equipment would be 34,000 Rand at the end of the lease term, which is less than the residual value guarantee of 40,000. Kiki Limited, the lessor, estimated on commencement date that it would be able to sell the piece of equipment at the end of the lease term of 5 years to an independent third party for 50,000 Rand. So this is a possible indicator of our unguaranteed residual value, only applicable to the lessor. They give me the incremental borrowing rate of Poly to be 12%, and then the fair value of the piece of equipment on commencement date is 400,000 Rand. Do not get confused with the dates. The 34,000 that we have indicated on top here is the estimated fair value at the end of the lease term. This fair value of 40,000 that we have there is the fair value at commencement date. It's not on the same date. In terms of IFRS 16, we need to discount these payments back to the present value of the lease payments using the interest rate implicit in the lease. Under scenario 1, we are going to determine the interest rate implicit in the lease, but that falls under the assumption that Poly Limited has knowledge of all the information provided above. Remember, I said that the interest rate implicit in the lease is determined from the perspective of the lessor. So the lessee needs additional information to be able to calculate this interest rate implicit in the lease, which is applicable to the lessor. So what would the calculation look like? Step 1 would then involve the calculation of the interest rate implicit in the lease, and I cannot stress enough that this calculation is done from the perspective of the lessor. It is the rate of return, the expected interest rate that the lessor wants to earn on this agreement. Based on the variables that I've identified from the definition in Appendix A, we will then calculate the interest rate applicable to this lease. Your present value would be the fair value of the underlying asset at commencement date, plus any initial direct costs incurred by the lessor. Be careful, it's from the perspective of the lessor, so we add the initial direct cost incurred by the lessor. The payments would be the annual payments over the lease term of 5 years. Determining those payments depends on what we have discussed in a previous presentation. The future value that we will look at here is important to understand. This is the future value from the perspective of the lessor. It would include any residual value guarantees payable by the lessee, as well as any unguaranteed residual value from a third party not being the lessee. In this example, the residual value guarantee is set at 40,000 Rand, but the estimated fair value of the asset has decreased to 34,000. So in terms of the amount payable under the residual value guarantee, the lessee will have to pay an additional amount of 6,000 Rand as a final payment. So what will the lessor earn? He'll get an asset back worth 34,000 Rand. He'll get 6,000 Rand cash back from the lessee, which equals the 40,000 residual value guarantee, and then he will be able to sell that asset for 50,000 Rand, which gives you that 10,000 additional unguaranteed residual value, which is the amount in excess of the initial agreement residual value amount. So the future value for purposes of the lessor is the full 50,000 Rand. With those variables, you are able to calculate the interest rate implicit in the lease to be 10.466%. When we now have the interest rate implicit to the lease, we will be able to calculate the present value of the lease payments at which the lease liability should be initially measured. For purposes of calculating this present value, we now do the calculation from the perspective of the lessee. It's the lessee who needs to recognize a lease liability. N is your lease term. Payments is determined according to the IFRS 16 principles. The interest rate that we now input is this 10%, 10,466%, which we have just calculated above in step 1. Focus now on the future value. Now it's the future value in terms of the lessee, and that would result in the amount payable under the residual value guarantee, and that is only the 6,000. How did I get to the 6,000? The residual value guarantee is set at 40,000. If the fair value of the asset drops below the 40, the difference is payable by the lessee. So the difference of the 6,000 is the only amount that the lessee will still have to pay as a final payment. With these variables, you then get your present value to be 378,256. Under scenario 2, we now need to look at the work process to follow if your lessee, Poly Limited, does not have knowledge of all the information provided above. And what would it normally be? It would be the unguaranteed residual value and maybe the initial direct costs incurred by the lessor. If the lessee does not have knowledge of this, he will not be able to calculate the interest rate implicit in the lease. Then the standard says, step 1, you cannot calculate the interest rate implicit in the lease. What do? You use the lessee's incremental borrowing rate of 12%. For purposes of calculating the amount at which the lease liability would then initially be measured, your variables will be as follows. N is still the lease term. Payment is still determined at the hand of the rules of IFRS 16. Your interest rate variable is now the lessee's incremental borrowing rate, no longer the 10% interest rate implicit in the lease, because you were not able to determine that. The future value is determined in the same way as what we just explained. That then gives you a present value of 363,882.